This is the Borderless Crypto Podcast. Hello everyone, I'm your host, George Manlov, and in this series I bring you exceptional entrepreneurs, investors, hustlers, and thought leaders from the cryptocurrency and fintech space. In this episode, I meet Clay Collins, the CEO of Nomics, an API-first crypto asset data company delivering professional-grade market data APIs to institutional crypto investors and exchanges. Now, this may sound very boring, but you'll be surprised how truly intriguing and entertaining this talk gets. We cover what Nomics does, how it sets the solid data foundations for the crypto industry to grow. And Clay and I also discuss extensively about trading volumes, fake trading volumes, and how Nomics fosters the adoption of best practices by crypto exchanges with its recently launched Exchanges Transparency Ratings. Last but not least, we discuss Clay's extremely successful podcast, his 4 a.m. morning routine, and his expectations of how Bitcoin will overtake the US dollar. This was one of the most educational and at the same time entertaining interviews I have done. I hope you will find this conversation useful and enjoyable, just like it was for me. Please note that anything that I or my guests say in these talks is for informational purposes only and should not be treated as investment advice. And although during daylight, I'm part of the team behind the crypto lending platform Nexo, at night, when I do these talks, I share only my personal thoughts, which in no way represent Nexo's opinions. Now it's time to get the podcast started in 3, 2, 1. So, Clay, it's great to have you here on the podcast. So before we jump in deeper into Nomics and exchange ratings that you recently launched, can you briefly introduce us to yourself? Tell us your story and how did you end up in the cryptocurrency space?
Yeah. So first off, thanks for having me. It's great to be here and honored to be on the show. So my background prior to blockchain was in the marketing tech space. I started a company called Lead Pages, which is a landing page and conversion rate optimization platform. Grew that to over 50,000 paying customers. We raised 38 million of venture capital, got to 150 plus people. And at some point, when we started exceeding around 120 people, I realized that I think I have no business running a company with probably over 100 people, at least with that company, which was my very first startup. But it was an incredible journey. I learned a lot. One of the things that I'm proudest of kind of working on there was we acquired a email service provider and e-commerce CRM called Drip, which is on a really nice tear here and growing at a fast clip. So at some point I went to the board. I told them that I think I probably shouldn't be the CEO anymore. And we hired our COO at the time. Now he's our CEO. He took over my role. I became board chair and left to start Nomics with Nick, my co-founder. I got involved in cryptocurrencies in around early 2013. I'm really interested in money and how money works. I'm really interested in computers. And so this was a nice combination of those two things. It instantly clicked with me. Everything had been digitized, pictures, music, movies. And it just made sense that money would have sort of a digitally native instantiation. And it's been just a fantastic journey. So that's how I got involved in cryptocurrencies. I can speak a little bit to Nomics as well, since you included that in the question. So Nomics is a market data API company. When I was looking as a trader, I was looking at data and I saw that it was really just a nightmare, that so many sort of basic things that are required to generate data that can power real-time trading environments, that can power quantitative strategies, that can allow you to confidently backtest. So many of the boring basics were just missing. And so we started Nomics, and we're an API-first company. Nomics.com runs on our own API. And the goal here is to provide the best pricing data and the best market data available anywhere. And I believe that we've accomplished that.
So that makes total sense to me. The need for high quality data is obviously needed for the cryptocurrency space to evolve and for more sophisticated trading players to enter the market. Can you explain a little more about how did you start? And can you sort of describe the Nomics universe as it evolved and what it is today? So for example, a few questions that come to my mind is, where do you get the data that you provide on Nomics that people can access via your API? Then this data that you get, what do you do with it? Do you massage it in some way? Do you work with it in some way? And then eventually, who are your customers? So who uses that data?
Yeah, so fantastic questions. There's so much to get into here, and
I'm looking more of a big overview. It doesn't have to go into too much details, but
totally. I get where you're coming from. So I think at a somewhat fundamental level, there's three problems that we solve.
Okay.
The first problem is data inconsistency. There's a lot of normalization problems across the space. So for example, you've got instances where the same symbol is used to refer to different tokens. So let's say you operate a real-time trading environment, or you're an arbitrager, and you see that on one exchange, BAT, basic attention token, is selling at one price, and on another exchange, you see that BAT is selling at another price, and there's a nice spread, so you execute a trade. It is possible that one of those is referring to basic attention token and the other one is referring to BAT token. So you've got inconsistencies with token symbols. You also have inconsistencies in how data gaps are reported. So on some exchanges, when candles are down or when markets are down, they'll just simply persist the last candle. They'll literally just repeat the last candle. So a candle, for those who aren't aware, is OHLCV. So open, close, high, low, and volume for a given period of time. So a 1 minute candle might be, what was the opening price at the beginning of the minute? What was the closing? What was the high price? What was the low price? And then what was the volume? And in many cases, you will see exchanges persisting the last candle when markets go down. Other times, when markets go down or there's no trading activity or a variety of things happen, they'll simply report zeros across the board. So they'll report open, close, high, low, and volume. They'll give you values of zero. So that's another issue. Another issue is around time zones. So a lot of exchanges, when they're providing data, will report times in UTC. Other ones will report in Korean time. Sometimes they'll give you a time and they won't even tell you what the time zone is. So you have to reconcile that. And not only will they give you data in different time zones, but they'll give you data with different levels of precision. Some will price to the second, others will price to the millisecond. And so part of what we do is we take data that comes from a variety of sources and we normalize it so that if you see a symbol, that symbol across the database means one thing. If you see a time, you know that time is in UTC. If a market is down, there's a consistent way of reporting that. So that's probably the most boring problem that we solve. The second problem that we solve is around data accessibility. Let's say you have a strategy or you have an idea, you have a hypothesis around a trading strategy, and you want to backtest that strategy to see if it's, at least historically, if that strategy would have been a winning strategy. Well, if you go to most exchanges and you request, for example, let's say you go to Bitstamp or you go to Bitfinex or Binance and you say, hey, I want all of your Bitcoin history. It is very unlikely that you can get that data in a period of time that's meaningful, that you can sort of evaluate the strategy and then execute, right? Unless you have a whole bunch of time to backtest. But because these exchanges have rate limits, and they should have rate limits, which means you can only sort of get data from them so many times per second. In some cases, it can literally take a month behind these rate limits to download enough data that you can evaluate what's happening. And then when you do get it, it often has gaps in it, and there's a whole host of problems. So kind of the second thing that we solve is data inaccessibility. You can get all the data from us up front. And then the third problem that we solve is around decentralization. So when we first started, if we integrated with, or if we were ingesting data from 5 exchanges, we were getting 50% of the trading volume on any given day. Now, today, in order to get 50% of the trading volume on any given day, you need to be ingesting data from at least around 50 exchanges. So over time, we're seeing this doubling of exchanges almost year over year. And that means that in order to know what's going on, you have to be getting data from more and more sources. And each of these sources is giving you data in a different format, and they've got different time zones and a whole bunch of issues. So it used to be that if you were a developer at a quant fund or a hedge fund and you wanted to know what's going on, you're just downloading data onto your own computer from a few exchanges, and then you can find opportunities in the data set. Like now, in order to find opportunities in the data set often and to know meaningfully what's happening in this space, you're probably spending a good chunk of your time just integrating with new exchanges and just being a data janitor and cleaning it up. So quant funds that used to have a dedicated person that could find opportunities are now finding that that person has to spend much of their time just cleaning up data, just integrating with new exchanges. And one, they're paying that person too much for that. And then two, that person then becomes a flight risk because that isn't what they signed up for, right? They signed up to do data science and to find interesting things in the data. So there's a lot more that we do beside that, but I think that describes probably the major categories of problems around data.
Okay, so if I have to summarize that, essentially you get the data from as many exchanges as possible out there. You make it consistent and super easily accessible for anyone at the click of a button, so to say.
Yep. And we also keep up with the space. So we're constantly adding new exchanges. And so, rather than having to go write a new integration, we just launched Binance Jersey last week, which is their first exchange with fiat pairs. And rather than someone having to go and sort of hook up that new integration, they could just, if they're a customer of ours, they just say, hey, I want the Binance Jersey data, and then they just get it.
All right, then I guess a lot of people, as they're listening now, would be thinking, okay, but there's other companies which are doing similar things as well, right? I mean,
oh yeah,
I'm not sure if they're doing exactly the same, but companies which come to mind as similar type of services like our CoinMarketCap, CryptoCompare, OnchainFX, probably many other. So how do you compare to those product-wise or customer-wise?
Yeah. So, so for institutional customers, those probably aren't I don't know that any of those are real competitors. But I can speak to how we compare. So let's start off with CryptoMarketCap or CoinMarketCap. That might be a good place to start. So CoinMarketCap gets the majority of their data from tickers. And there's a lot of issues with tickers. Tickers are kind of like crappy candles that come in. I wish I could share my screen here, but they're kind of like crappy candles that come in whenever they're computed and you get them. So if you think about data quality, there's a bunch of different levels. So probably the highest quality market data is trade data, which means you're getting every single trade that's happening on an exchange. The probably, a little bit worse, but okay data is candle data. So that's for a given trading pair, what's the open, close, high, and low. And they're minute candles, they're hour candles. They close at these defined boundaries. And then you've got the worst available type of data, which are tickers. And tickers are kind of like 24-hour candles, except they don't close at specified boundaries. They just close whenever. And they give you a ticker is the opening price, the closing price during this 24-hour period, the high and low, and the volume. And what exchanges have found is that you can hide a lot of wash trading and a lot of fake volume inside of a ticker because it's for a 24-hour period. You don't have to provide any data other than 4 to 5 data points. And you don't have to give any kind of fidelity other than hey, here's, we have $1 billion in trading volume in 24 hours. So you can just stuff that with fake volume, almost like you're just like a duck in pate de fourquois. You can just shove it in there. So it's not really great data. And one of the things that's difficult about this kind of data is that if you do want to get minute candle data from ticker data, it's very likely sometimes that only one ticker closed during a minute period where you want to construct a minute candle. So that means if you're constructing a minute candle based on tickers, the open, close, high, and low during that period is all going to be the same number. So it's a real problem. So I personally don't know any quant funds that are using CoinMarketCap to make trading decisions or for backtesting personally. So I think that's what I'd say about CoinMarketCap. I also think that there's a discussion to be had here about pricing and pricing methodology and how we price. So let's talk about that for a second. So you can get into these really circular patterns with pricing. I'll give you an example. Let's say you want to price, and I think a lot of people don't realize what really goes into pricing an asset. So let's say we want to price an asset like 0x, okay? There is no USD price for 0x unless there's USD trading pairs. What there are is there's a whole bunch of trading pairs that's like 0x to Ethereum and 0x to whatever might exist out there. So there can be multiple 0x trading pairs on multiple exchanges. So like, how do you price it? So you might start off with all the 0x trading pairs like 0x to Ethereum. But then the question is, how do you price Ethereum? Because you need to price Ethereum in order to price 0x, right? Mm-hmm. So do you include all the Ethereum pairs to price Ethereum? So let's say you have an Ethereum pair like Ethereum to Tether. All right, so you've got Ethereum to Tether. Okay, well, how do you price Tether? Because now you have to price Tether so you can price Ethereum, so you can price 0x. So how do you get the price of Tether? Do you use markets like QTUM to USDT to price Tether? Okay, and if you do you really want the QTUM to USD, the QTUM to Tether pair? Do you really want that being used to price like Bitcoin or 0x? So
I never realized how complicated this can get, but yeah. Okay, go on.
Yeah. So it gets super complicated. You've got to kind of figure out how you're going to approach this. And I can't speak to, I'm not going to name names here, but we kind of alluded to them. What we've seen with a lot of these providers is incredibly circular pricing, where you're using Ethereum to price 0x and you're using Tether to price Ethereum and you're using, QTUM to price Tether. And then you get to a point where these prices are just so out of whack with reality. Because nobody who's trading QTUM to 0x, if that even is a market, nobody who's trading that is like anchored to reality. You're so far away from money where you understand the value of it and there's great price discovery. So how do we price? We start by pricing Ethereum and BTC against fiat pairs. So we'll find every BTC to a fiat pair and every Ethereum to fiat pair, and we'll price Ethereum and Bitcoin based on fiat prices, right? Based on money that people get paid in and buy things in the grocery store. Once we've priced Ethereum and BTC, then we find trading pairs where Ethereum and BTC are the quote currency, and we'll use Ethereum and BTC to price everything else. That's essentially how we'll do it. So if you go to nomics.com and you look up the price to Tether, or you look up the price of Tether, it's generally lower than like a CoinMarketCap might report it. And the reason for that is because we are heavily anchored to fiat when it comes to pricing. So there are a handful of USD to Tether pairs. And generally, people who are buying Tether with US dollars are paying less for Tether than people who are buying Tether with like Bitcoin or Ethereum. So we're very fiat anchored versus like la la land money, magic money, internet money anchored when it comes to our pricing. I think one place where we differentiate on data quality. So, I was talking about tickers. So if you've got first, second, and third place, you've got raw trades are the best. You've got candles, which are constructed from raw trades, and then you've got tickers, which are absolutely the worst. So we construct all of our own candles. Like if an exchange has raw trades, we'll build the candles ourselves versus just asking an exchange what it is. Because we found in some instances that exchanges are actually reporting in candle data inflated volumes. And when we actually get every single trade that happened that is creating that candle and compute it ourselves, we'll find that they're overrepresenting their volume. And that also ensures that there's a consistent way of computing candles across the entire system. Anyway, this is super nerdy data stuff. I hope people are getting something out of it. But so I think differentiator one, data quality, we're heavily oriented towards raw trade data. Second, I think our methodology for computing prices gets you the most realistic prices possible. And so I think those are 2 points of differentiation. I think a third point of differentiation is just kind of like how we're set up as a business and the product itself, which is an API first company. So all the companies that you mentioned, they're not API focused. Right. And many of them make much of their money, maybe most of their money, by selling CSV files. So you're literally going to like the CSV e-commerce store in like adding a file to your shopping cart and checking it out. And that works well for research purposes and it works well for analysts, but it doesn't work well for fintech developers. It doesn't work well for quant funds. It doesn't work well for high frequency traders. It doesn't work well for the vast majority of the fintech universe. And so I think when it comes to having a squeaky clean API that adheres to modern development practices, that does a lot for you and can integrate nicely with how engineers build software, that's another point of differentiation. And I think we've been rewarded well for that. Like if you Google cryptocurrency API, at least yesterday, it changes around a little bit, but if you Google cryptocurrency API, we're usually first. I think I changed my title tag a little bit recently and we dropped down, but like we're usually first for that term. So I think those are a few different points of differentiation.
Okay. And don't you think then, because one thing I found curious when I was looking at your website and there was this FAQ section where, because basically you have this free version of your API and then the paid one, right?
Yep.
So you were very positive and even encouraging others to use the free version of your API. So they built websites and services such as CoinMarketCap. So like, I'm just curious. So for example, like CoinMarketCap, me personally, for example, because it's the biggest website that is out there, many people just use it. It's the go-to place. So for example, why wouldn't they use you, for example, so they have a better data and people are just still going to go there because they have the brand. It's established the place. I would be just curious to hear your thoughts on this. What is their rationale as to holding up to the ticker approach?
There's a lot to explore here. So there's a free version of our API. And the reason why is because the paid version, there's a very prescribed set of use cases where someone pays for data. And most people do not want to pay for data. And so rather than trying to like convince everyone to pay for data who maybe shouldn't be, or there's not like a business use case for it, if it's just for personal use, then they can use the free version. And the free version is limited, but I think it gets most people, who are just doing kind of basic fintech apps. If you're just creating like an iOS app or something like that, it's probably going to be fine. But if you live and die by your data, or if good data versus bad data is going to create a competitive advantage for you, or give you a trading edge, or something like that, then you're probably only going to be satisfied with our paid API. And for people who are paid customers, like we frequently say to them, like we have no issue with you competing with Nomics.com, our own CoinMarketCap competitor. Like build a competitor to us. And we don't care if you beat us. I'd rather have the next company that beats CoinMarketCap, whether it's us or someone else. I'd rather that they be using our data and our API. I'd rather they be a customer of ours. So we have no issues with that. And at some point, we're probably going to even open source our entire front-end website and just give it away, in addition to, Android and iOS apps. We'll probably just give it all away because at the end of the day, we're an API company. And if we put out really good source code that shows people how to use our data and apply the data, that's only going to enhance the API business. So in terms of like, why do people go to CoinMarketCap versus someone else? I think CoinMarketCap's time is limited. They've run a lot of shady ads. I think that honestly, their product hasn't grown a lot historically, and like they're definitely incumbent to beat. And I think it's just a matter of time. I think that it's great that they started, and it sounds like it was initially a hobbyist project. But I think eventually the pros get involved and the space starts getting commercialized and things start growing up. And then like real engineering teams and real business operators eventually prevail. But who knows, I could end up in a pretty humbled place 3 to 4 years from now. But that's what I believe. And we've tried to go 360 in terms of how we approach professionalizing the space. Like our phone number is on the homepage. If you go, like just basic things that people take for granted, like we have a phone number. If you go to the About page for us, you see our names and our faces. You can't go to CoinMarketCap and see anyone's name or face. There's no phone number to call. Everyone's anonymous. And it's like, that's okay. Maybe that worked during the crypto anarchy days of this space. But if you're trying to build a viable business, I think the story changes and the standards are higher. So a little bit about us, we're backed by Coinbase Ventures and Digital Currency Group and City Block Capital. And I think we are part of the professionalization of the space.
Definitely looks like it. So on this topic that you're sharing, I personally, from my experience and the problems and the discussions we've had at Nexo, even data that comes from a lot of these incumbent companies is not enough for us. And sometimes we just need better data because we need it for our business, right? I mean, for example, the way it works for us is we have coins which we accept as collateral options for our instant credit lines. And we need to have access to markets and to know what is the liquidity, what is the volumes of any particular asset that we support. And so when it comes to Bitcoin or Ether or, the few biggest coins, that's kind of okay because their volumes are good. But when it comes to even getting out of the top 5 coins, top 10 coins, it's like you need to know the data and you don't have an easy way to get correct data. I would be curious to learn. So this is a great, I guess, transition into the big topic of fakeness, so to say. So fakeness is a big theme, I would say, not just in crypto, but everywhere. I mean, there's fake news, there's fake people, there's fake volumes here that we are facing. And I definitely think that this has to be solved one way or another. So the big kind of push, I guess, everyone knew that, there were fake volumes. First, there was this report in February that I came across from CoVenture that said, basically identified some exchanges with supposedly top exchanges, which have 99% volumes that are fake. And then very recently, Bitwise came up with this report saying that 95% of all of the Bitcoin's trading volume is fake. So what is your response to that as a data company? And how do you address the fakeness of the operations of exchanges?
Yeah, man, there's so much meat on this bone, so to speak. So as a data company, we looked at the Bitwise report, which we're pleased about. We hope their ETF gets approved. We like Bitwise. And I think of everyone who's put in applications to run an ETF, I think theirs is perhaps the most impressive. And I like that they're a crypto native company. So I hope theirs is the first one approved. I hope there's also more, but I hope theirs gets approved. So they identified 10 exchanges that they felt had real Bitcoin to USD volume or Bitcoin to Tether volume. And so the first thing is I just kind of stared at those exchanges. I was like, well, what do most of these have in common? And what I noticed was that primarily what they had in common is that they all provided historical raw trade data, historical gapless raw trade data, as opposed to candle data or as opposed to ticker data, which is sort of aggregate things. Like if you're looking at a candle, you've got the open, close, high and low, but you don't have every single trade that happened during that period. So I was like, wow, they're really, for the most part, 8 out of these 10 exchanges are pretty transparent. And sure, you can have fake volume and offer historical raw trade data. But just like being audited by the IRS or any kind of audit, at some point, if you provide enough data points with enough history, and again, 8 out of these 10 provided like complete history. If you provide enough data with enough history, at some point, you're going to get caught. Mm-hmm. So certainly, if you are engaging in shenanigans, you do not want to be providing historical raw trade data. So then we looked at the suspect exchanges. Those were exchanges that Bitwise explicitly called out as doing things that looked pretty shady. And we found that of those around like 20 exchanges, only 2 of those exchanges provided historic raw trade data. So we've got the good group where 80% is providing highly auditable data. And of the bad group, you've got, it looks like around 90% are providing the worst data type available and data that allows you to just kind of like stuff all kinds of crap in there and not have to report it. So we started seeing as like sort of this data transparency as a proxy for good behavior. Now, this isn't the ultimate. This just because an exchange is transparent doesn't mean that they are universally engaging in good practices. And one of the things that we've kind of got as a result of our data transparency ratings are people coming to us and saying, hey, you gave this exchange an A, but yet, they do this thing that I don't like. And what we've said to those people is like, these are not business ethics ratings. These aren't customer approval ratings. These are data transparency ratings because we're a data company. We have no business speaking to a whole bunch of other things, but we do have some business speaking to data transparency. And humans are not making decisions about these transparency ratings. They're made by a machine. that looks at the data that is made available by that exchange and then assigns it a score. So what I felt was needed after reviewing the Bitwise report is some kind of system that is updated on a day-to-day basis, because Bitwise said, all right, there's only 10 exchanges that have good volume, but that could have changed the next day. It could have been like the next day there's more exchanges that are doing great things, or it could be the day after it came out,
they stopped caring.
One of the exchanges stopped caring. It's like, hey, Bitwise says we're great. We're gonna now let's start stuffing volume into these candles. So we wanted to come up with some kind of rating system that was updated and basically just speaks to the auditability of the data provided. But I think this rating system is going to change over time. We'll start incorporating machine learning to start detecting fake volume in real time. But what we're saying about these exchanges is that they're highly transparent and that they provide high quality data and they don't appear to be hiding stuff.
Really cool. Okay, so basically you're also planning on building on top of this. So basically, because today you have 5 ratings, right? Or I would say 6. So you have these 5 ratings, A, B, C, D, F.
Yep.
So A being for top performer and F for fail. And then you have A plus for the ones who have themselves integrated with you.
Yeah. So essentially, we wrote a spec that describes ideally what exchange data would look like.
Okay.
And so if an exchange comes to us and writes their own integration with us, then it means that we are absolutely getting all the data that we want, and we're getting it in the format that it should be served up in, and that it adheres to all of our standards for data quality. So if an exchange gives us data in a very specific format that we've defined, then they're an A+. But if they're generally giving high quality data, we'll give them an A, but an A+ is reserved for people who are giving us data according to our spec.
Got it. So one thing I've noticed would be curious to hear your thoughts on this. So for example, among the exchanges that you listed as transparent, it was BitHump, right?
Yep.
And I was just reading also the reports that CoinVenture published a couple of months ago, and they gave explicitly the example of BitHump as an exchange which actually, so to say, has a lot of questionable practices. And basically for multiple reasons, they concluded that there is significant wash trading there. So how do you reconcile that? Because that's really, and there what CoinVenture gave as examples and then arguments was really strong. For example, they said there was this period of time where supposedly BitHump started this airdrop campaign, and supposedly they said that a huge amount of new people came into the platform. So that's why the volumes jumped high. But then when you looked at the Alexa analytics, you see that there was actually a lower amount of visitors that came to their website. So that didn't make any sense. And then when they looked even deeper into the trading data, they saw these large spreads and high volumes, but at the same time, low volatility, which they interpreted as indication that, again, something's wrong. There's probably more wash trading here happening than real ones. So how do you reconcile that? The idea of these ratings, in my opinion, is like these exchanges are legit. And then I see a very well argumented report, which actually says this exchange in particular is not legit.
Mm-hmm. Yeah, no. So we are not saying these exchanges are legit. We are saying these exchanges have highly transparent data practices, which is completely different things. We're speaking to data quality and sort of investigatability of these things. So first off, I don't doubt that CoinVenture is doing great work. They're investors in us and they invested in our A round. I know Atit over there. I am personally an LP in their active fund. Okay. So they've not only invested in us, but I'm an investor in one of their funds. And so nothing but utmost respect for those people and for that whole group. So yes, I really want to, maybe this is a prompting here. Maybe instead of transparency rating, we need to just call these data transparency ratings, which we do in the article, but we don't on the webpage because we ran out of text space. So what we are saying here is that it's kind of like, let's say you go to a business and you say, show us your books. And one person comes in and they say, all right, so here's how much revenue we did every day. And you go to another business and you say, show me your books, I'm auditing your business. And they say, oh, here's every receipt for anyone who ever bought anything from us. And here's every receipt for everything we bought. So that's kind of the difference between exchanges that have a low rating. Those are the ones that are saying, hey, we'll just tell you what we did every day. And then the businesses that say, here's every single receipt for anyone who bought something with us and for everything we ever bought. So that second group is the group that's getting an A rating. Now, could the group that's in this audit scenario, could the group that's providing every single receipt for everything they bought and sold, could that group be selling drugs? Yes. Could they be not issuing refunds? Yes. Could they be doing fraud? Yes. But because they're giving you a complete paper trail, you're much more likely to catch it. So they are being more transparent. And that is all that this rating system is right now, is we are speaking to the auditability of the data on their platform. So going back to the CoVenture report, it does not surprise me that CoVenture identified BitHum as engaging in these kinds of activities. And probably one of the reasons why they found it is because BitHum is providing such complete historical data. And I don't know why they would be doing that. So one thing that we're going to be adding, and these things are evolving over time, it's kind of like fighting spam. So when you think about how spam first started, all right, so people send an email and it says, porn, Viagra, whatever it says. So Gmail or whoever is doing the spam filtering is this like, all right.
just became explicit.
Yeah.
But okay.
Oh, no, that's not, I didn't say a curse word. So they start filtering for all right, if you have these words in the email, then you're going to go to the spam folder. So then the spammers got better and they started using like a 0 instead of a O in the word porn, right? So then the Gmail or whoever starts filtering for that. And then the spammers are like, okay, well, you caught us there. So now we're just going to put the word in a picture and we're going to send the picture, or we're going to have a combination of like Cyrillic and traditional Latin letters, or like whatever you're going to do. So the truth is that all of this stuff is kind of like spam in that it's an arms race and it's never ending. The war against spam is never over. There's always something that makes it into your inbox or some kind of phishing scheme. It's never going to be perfect, and it evolves. So this is our version 1. This is in terms of ratings for exchanges. I think of the ratings that exist, I like ours the best. I think it's the most comprehensive. CoinMarketCap doesn't have one right now. OnchainFX doesn't even have exchange listings right now. And I think you said CryptoCompare, they're not rating them. So I feel like we have a great version 1 in place. And it's not perfect. It's never going to be perfect. We're thinking about creating how we have it. We've got an A+. We're thinking about creating an A- for exchanges that we are dinging for a variety of reasons. But honestly, I kid you not, every single one of these exchanges, someone has come to me and be like, hey, Binance. Yeah, they're really, I had this terrible experience. I can't believe Binance is on here. Then someone else is like, it's every single one of these someone has been, had some issue with. So people have strong opinions with exchanges, and then they start adding KYC AML, and then they block you from withdrawing your funds for a couple of days. And then people get really, really angry with centralized exchanges. So none of these are without flaws. And I think it's interesting to note that the Bitwise report, which everyone is holding up as being awesome, they identified Bitfinex as being an exchange with actual volume. And Bitfinex is currently being investigated by, New York State for shenanigans around Tether and like 280 million or whatever's going on. So the truth is both of those things could be true. Bitfinex could have actual volume and they could be engaging in a ton of bad activities. And they could have a high level of data transparency all at the same time. So there's not going to be a catch-all for everything on this list is good. But I think with respect to our criteria, I feel like our ratings are good. And we might introduce the A- to downgrade things that are obviously, doing bad things and according to law professionals or the criminal justice system or what have you.
Right. No, I totally agree with you. You could have one company or one actor who is good at one thing, but really bad at another. And that's absolutely normal. And it's kind of you have a lot of people who have this kind of, I guess it's probably just a natural human bias, which we have to constantly fight, each and every one of us, that it's not because somebody has some bad feature, so to say, that you have to attribute this badness to the whole entity, so to say. So you have to make clear distinctions between what exactly you're talking about, or why do you like a certain exchange, or why you don't, or what is good or what is bad for a certain exchange. So that makes total sense. So another thing which I I really liked basically about your approach is that you kind of are trying to establish this new standard of operations for a transparent and in the future probably a more general approach. I don't know what your plans are, but maybe a more general standard for what a legit exchange is. So what is your plan on that? How do you plan on incentivizing exchanges on actually following good practices and so that we get rid of fake volumes?
Yeah. So great question. So we have a huge bias here. All things being equal, we want exchanges to provide more data. And we think it's better for the space, but it's also better for us. Like we are clearly biased as a data provider that gets data, at least some of our data from exchanges. We definitely want the exchanges to be transparent. So what we do is when we are ranking markets, when we're ranking exchanges, when we're ranking anything, we are placing exchanges, we're sorting first by data transparency and second by volume. So you don't just win if you create a bunch of fake volume and say you have more trading activity than anyone else. So like right now, I'm just going to do this in real time just to see what's going on. So I'm going to CoinMarketCap and I'm going to exchanges and I'm sorting. All right. So the first exchange by volume today on CoinMarketCap is BitMax. What the hell is BitMax? I don't know. I've never used BitMax. I could probably call everyone like I've ever met who trades cryptocurrencies, and I don't know anyone who's ever traded on BitMax. All right, so the next one is BitMax. Okay, that's legit. The next is Fcoin. What the hell is Fcoin? I've never even heard of Fcoin. Like I'm on crypto. I live in this space. Fcoin? What on? So that's the third highest exchange by volume. Okay, the next is OKX and Binance. I know that. Number 6, ZBG. What the hell is CBG? I have no idea what this is. So, and then DigitFinex and BW, and then FatBTC. FatBTC is outranking like, then you got CoinBene. I like calling it CoinBean, which is, and then LBank and Coin. Like nobody's heard of the vast majority of these exchanges. Like, so if you're looking at this ranking, and let's just say I want to find Coinbase. Coinbase on this list is number 43. 43.
Right.
Bitfinex is number 37. So Binance, right, is number 5. It's ridiculous. So if you go to our exchange rankings, we are sorting first by transparency and then by volume. So our top 5 exchanges are Binance, HitBTC, Bitfinex, Coinbase Pro, and Kraken. Those are our top 5 exchanges. Now, you might hate some of those exchanges, but I bet you've heard of all of them. You know, none of these are like coming out of left field. These are established players, and these are not sorted by judgment calls. These are sorted by like us looking at our database, seeing what they're giving in terms of fidelity and doing that. So if you want to appear at the top of the sort on our exchange list, if you want your markets to appear at the top of the sort, let's just do what I was doing before for Bitcoin market. So I'm going to go to CoinMarketCap. And I'm on the website right now. I'm going to Bitcoin and I'm looking at their Bitcoin markets, right? And I am sorting by volume over 24 hours. Okay, so I'm going to read off the top 10 exchanges for Bitcoin volume on CoinMarketCap. Okay, so the first one is BitMax. Okay, you've heard of that. Next one, Fcoin. Okay, what the hell is... The next one is Negoci Coins. Okay, and that is BTC to BRL. It's probably like some, I don't know if that's a Brazilian currency. So I've never heard of Fcoin or Negoci Coins. The next one, CoinBene, which was sort of the all-star of the bad actor in the Bitwise report. Next, BW. Okay, again, I don't know anyone who's traded on BW. ZBG, then CoinEal, then IDAX, then CoinAll. And then it takes until you get to like 10 or 11 to get to like OKX and then Binance. And then but it's just like all that down the list. And then if you go to our rankings, sorted by volume, it's the first market is Binance, the second market is Bitfinex, the next market is Coinbase Pro, the next market is Bitstamp, then HitBTC, then Kraken. So I feel like sort of the feedback we've received is that this data is much more meaningful and relatable. And it actually means something when people look at it versus being like, an all-star sorting of people pumping volumes. It's like all the cheaters are at the top of the list.
Yeah, no, honestly, I don't know if anyone gets anything out of these rankings, specifically the exchanges rankings. The cryptocurrencies rankings, okay, that's fine. They're kind of Okay, for the average person, even if you are not the professional founder or trader. But the exchanges, really don't make any sense to me, and I don't know if they make any sense to anyone.
Hey, this is George jumping in here for a bit, just to make it clear that shortly after I had this talk with Clay, CoinMarketCap also announced their own Data Accountability and Transparency Alliance, alongside with some of the leading cryptocurrency exchanges out there. To me, this is great news, as the fact that pretty much all major data players in the cryptocurrency space are taking resolute actions towards promoting best practices when it comes to reporting of trading volumes. This is only good for the whole industry, and I believe it can only benefit everyone who is involved in the cryptocurrency space. And with that news, I also expect and hope that some of the inconsistencies and strange results that we see on the CoinMarketCap rankings at this point, and that Clay pointed out, will soon be part of the past as well.
I have a final, strictly company-related question to Nomics, which is what are your biggest challenges, or what do you need so you move faster as a company? What are your biggest challenges and bottlenecks, I would say, or the things which could make the most difference for the growth of your business?
So it's 100% focus. It's 100% focus. So the reason why the opportunity exists like it does for us, and the reason why we've been stealing customers left and right against the incumbents, is because nobody is doing the boring basics right. And when you think about everything that most people that start a startup love about product, it's, wearing a turtleneck and New Balance shoes and trying to be Steve Jobs, and their taste is amazing or whatever. And so much of what we do, it would melt your face off. It's so boring. It would really bore you to tears. And it's about getting data right. And so I tried to make this discussion interesting, but if we were to have the real conversation, it would just be infinitely boring, and we'd be talking about all kinds of tedious things that most people don't think about until they're absolutely dependent upon data, and then they find themselves wanting to jump out of a window because it's so painful dealing with what they have. So what we've seen is a lot of people, they just keep on adding more stuff to what they're doing. They're like, oh, we're going to add GitHub analytics, and now we're going to add social data, and now we're going to add 20 technical indicators, and then we're going to add a community where people can talk about this stuff, and then we're going to add news, and then we're going to add this thing and that thing and the other thing. And when I see other companies do that, I start feeling happy. This is really great for us. So I like product, and I like thinking broadly, and I enjoy vision and all that stuff. But for us, this core problem of data quality still remains, it's a challenge in there, and we have so much more work to do, and we have so much further to go that I think we're constantly fighting the urge to add more. And one of my favorite sayings is that most startups die of indigestion rather than starvation. And I think that's true of companies in the space, that we could go really broad or we could go really deep. And I saw on Twitter the other day, there's a guy named Dharmesh Shah, who's one of the founders, I believe still the CTO of HubSpot. And they're a public company. They're worth $4 billion or something. And he tweeted, this was his tweet. It essentially said, your customers don't want you to build new features. They want you to nail the features that they bought your product for in the first place. And I think in most cases, that's really true. So the biggest challenge for us is just always staying true to our product objectives, which is better quality data, transparent methodologies, being a force that encourages the entire space to provide more transparency, nailing the API as a product. That means the docs are good, the endpoints are good, the response times are fast, the error rates are low, and making sure that we have more data than anyone else. So when we first started all of this, it would take us a few weeks to add an exchange. Now we can add an exchange in 10 minutes because we've built systems around this. So for us, it's really about focus and not getting distracted and staying true to why we started.
Right. Yeah, this reminds me, by the way, of my first guest, Jamie Finn from Securitize, who said pretty much the same thing, just in different words. I said, you as a company are defined mostly by what you don't do. Right. So because exactly what you said, many companies try to just do everything. and securitize, and you have a very, very clear focus and you refuse to go any other way. So cool.
Yeah, I agree with him. I think he's right.
Right. So with that in mind, and with your approach with your attitude of not being a boring data company, I would like to explore a little more about why did you decide to start the Flippening podcast? So as some of our listeners may not know, you, aside from being the CEO of Nomics, you also have the Flippening podcast where you talk about investing in crypto, like themes connected to investing in crypto. So what was the reason for you to start doing this as well? Because and to continue doing this, because as you said before we started this recording, this is really taking a lot of your time.
Yeah, so I have a podcast called Flippening. It does pretty well. It's usually in the top 150 in the business section in iTunes. Our average podcast is getting anywhere between our average episode between 30,000 and maybe 40,000 to 50,000 downloads. We crossed the 1 million downloads mark a while ago. So it's gone well, but it's also been a huge pain. And so thinking a little bit about who we wanted to be as a business, I know a lot of data companies have a huge media presence. Not only are they putting out data, they're releasing reports, they're breaking news, they have a whole team of analysts. And we decided early on that we were going to be a product and an API company, and we were not going to be a media company at the end of the day. So we don't have a daily newsletter. We're not blogging left and right. So the one thing that we do is we do this podcast, and it's been a lot of fun. We put out a documentary on security tokens and security tokenization, and a lot of podcasts are kind of topical and conversational, and our approach, which is, it's good for us, but it's just our approach, is it's really focused on deep dives on specific topics. So we did a 2-part deep dive on OTC desk trading. We did a 2-part deep dive on investing in smart contract platforms. We had a 2-part deep dive on tokenized debt. We had a 2-part deep dive we had a 3-part documentary on security tokens, and on and on and on. And the reason why I did this is because I've got quite a bit of experience creating content in past life. And I realized that topical content eventually gets old, and when you interview famous people, that might be fun at the time, but they're usually not famous forever. So we wanted to create this evergreen reference content that hopefully would stand the test of time, and that people could return to again and again to learn about large, important topics in the space. So that really is what drives the podcast. And there's a couple of reasons why we do it. One is that it's a fantastic customer acquisition channel. It's the only podcast that I know of that is truly focused on institutional investors and on full-time investors and essentially full-time professionals in the space. And, as opposed to having more of a consumer audience, we're entirely focused on institutional investors, and those are incidentally people that buy the product. In every podcast, we have an ad for our API. And we usually have one title sponsor who's an external sponsor, and we have one internal sponsor, which is us. And it absolutely gets us customers. So that's great. I can say that to advertisers is it gets lifts. Every episode we put it out, we get at least one new customer, and our product isn't cheap. So at least the higher tiers. So it's customer acquisition. It's the only media thing that we do. So it's the only thing we're known for in terms of communicating with the space. And I think another reason is that it keeps me off the street. It keeps me from bugging our engineers all the time and pestering people. And I really enjoy asking questions. I love asking questions and getting to learn about new things in the space. So at the same time that I hate the podcast, I absolutely love it as well. It takes so much time. It costs us anywhere from $1,500 to $3,000 to produce every episode. And we have transcriptions made before and after. We do pre-interviews. It's a whole thing. And we just hired someone to full-time joining us, and half their time is just working on that damn podcast. So it's the one thing that we do. And so we figured we might as well do a good job at it. And it's been a fun journey.
Yeah. No, it sounds totally good. And I can confirm, as I haven't listened to literally all of your episodes, but to quite a few, specifically the security token documentary, which numerous people recommended to me. And I can definitely say it's a really, like this particular one, but I'm sure the other ones you cited as well, very good intro to anyone who wants to get into any of these topics. So just curious, so this I'll probably cut out. But if you were to do, because you said that the security token documentary, for example, took you really a lot of time. So if you're to do this from scratch or when you're doing similar things now, how would you do it differently?
Yeah, so great question. And you can leave this in. I think the key with doing an audio documentary is to get a sense of the structure ahead of time. So when I did the security token documentary, I interviewed a bunch of people. I had all these interviews lying around. And when you're publishing an episode like the one we're doing together right now, what's nice is that the timeline is just the conversation. You don't have to storyboard or construct a timeline and weave all the things together. When you're creating an audio documentary and you're cutting back and forth between people and someone interjects and has a comment and then you cut back to the main person who's being interviewed and then you weave to something else someone said, there's no natural flow to it all. So you need to get all the episodes transcribed. You have to break them up into meaningful chunks, and then you have to cut them up and reassemble them together in a way that makes sense over 2 to 3 episodes. And it's a lot of work. So I think what I would do next time is I would, to the extent that I can, because sometimes there's gems that you don't expect, I would map out the whole thing ahead of time, beginning to end over all the episodes. And I would kind of know where the transitions are ahead of time. And I'd probably do more pre-interviews and I'd know who has what to say about what. And then everything would just sort of hopefully click into place and it would make the editing a lot easier. Hopefully, who knows? But
okay,
that's the intent.
No, that makes sense. All right, great. We look forward to future documentaries you'll be publishing. So another question I really wanted to learn or get your input into. So you have been very successful with your business ventures, as you described, lead pages, right?
Yep.
So I don't get it wrong. Lead pages and Nomics is obviously going very well at this point. You also mentioned in our prior conversations that you tend to be a very early riser. Would be very curious if you could briefly describe how your day looks like. And why do you get up so early and what's your routine, so to say?
Yeah. So like my entire life, I have not been an early riser. And so you did have that right, that I'm up super early in the morning. That happened when I had kids. So I think 2 things happened recently that affected this. Yeah. So ideally in a past life, I'd get up at 9:30 in the morning, 9:30 a.m. And I'd stay up until 2 or 3 a.m. And that's when I'd go to sleep. And that's how I used to live my life. And then I got married and I had kids and I love them. And it's the best thing that I did not expect would be great. I didn't know. It's like, this could suck. I don't even know. But it's like, everyone says this, but it's like best thing that ever happened to me. So essentially I'm up in the morning because that is the only productive time that I have. So I am absolutely committed that at the end of the workday around 5:30, I'm going to be home and I'm going to be feeding my children dinner, and then I am with them until they go to bed at around 8 to 8:30. And then because I am up so early, that's when I go to bed. So the only way to get to work the hours that I work is to get up at 4, 4:30, sometimes 5, but is to get up at that time. So the first thing that happened is I had kids. And the second thing is my entire life when I was younger, I was diagnosed with ADD, but I never took like Adderall or any of the attention deficit disorder medications. And now I do. I don't think it's too weird to say, but yeah, I take Adderall. So I get up, I take an Adderall, and I'm definitely up. So yeah, I like it. I like it quite a bit. I don't know that I could go back to the thing I had where I stayed up late and got up late. I very much prefer this. I think I'm a lot more productive as well.
Okay, cool. I never heard of this particular type of people going to bed at 8 or 9, but why not? I mean, I'm going to probably try this at some point as well. I used to be an early riser when I was younger, and now I kind of switched the other way around. But maybe I should just get kids, and I'll be forced to switch.
Yeah.
Okay.
Yeah. And I should also add that something that's, this is often la la land or, woo woo territory, but I get up in the morning and I meditate. And I do this thing called the Wim Hof method. Originally, I started doing it because I thought it was going to help me lose weight. Wim Hof is this Dutch guy who holds the record for swimming the longest underwater. And he climbed Mount Kilimanjaro in like shorts and nothing else. And he's just done all these crazy things. And so he trains people how to adapt to cold exposure. And I was like, oh, this is really great. I'll just take like super long cold showers and I can burn more calories. But one of the things that he teaches you to adapt to cold is a breathing pattern called, actually, I don't know what it's actually called, but it has to do with purposely hyperventilating and doing a number of things. And I've always tried to meditate in some form or another, but I do this and then I meditate and I can meditate for as long as I want to. And each time I do this breathing exercise, I go deeper and deeper and deeper and had some kind of crazy spiritual experiences as well, which I won't talk about. But that's a huge part of my life now is getting up in the morning and doing that stuff.
Wait, so you take a continuous cold shower? Is that what this practice is about?
Yeah, so I take a cold shower. There's 3 components. It's cold exposure, breathing exercises, which you do separately, but you also do it when you're being exposed to the cold. And the breathing exercise is this combination of like hyperventilating and then also holding your breath. So I'm at the point now where I can hold my breath for like 2.5 minutes, which is not, you can do it for like 6. I would really like to get to 3. And the third component is these exercises. And then there's also meditation. And it's just what it is. I don't think it's a cult. It's just been something that's been practically helpful to me.
Yeah, sure. You just try and see how it works. No, awesome. Cool. Very, very, very interesting. Definitely.
That just went up.
Yeah. Okay. So a few final questions here. So I was just curious, you said that you entered the crypto space, so to say, in 2013. What was the trigger that you realized, okay, this is going to be huge. This is the next big thing. Like digital money makes sense. Did you listen to somebody? Did you read something?
Yeah. So it wasn't one book, although I did read Digital Gold early on and really enjoyed that. So I think it's a really well done narrative account of the early crypto days. And that I found that compelling and interesting. But I don't think there was any one thing. There's someone that worked at my previous company that I started who was a cryptocurrency miner and someone whose intellect I really respected. Even in 2013, it'd been a long time had passed. I think, started in 2009? So from 2009 to 2013, Bitcoin had never been, the network had never been hacked. Hashing power was growing. And it was just a really compelling time to be involved in the space and still is. But no, there was nothing that pushed me over the edge. I really enjoyed the Bitcoin white paper and found it interesting. And I really like having non-seizable money. There was just so much about this that just it just clicked. Like everything that I'd come to believe about the world and how the world works and decentralization over time, like this, it all just was like, yeah, there's nothing about this that doesn't seem spot on, this movement. Maybe it's not going to be Bitcoin. I think it is, but it just all clicked. And I went down the proverbial rabbit hole and, it was that guy who was unshaven and tired because I'd been up all night, reading some stuff. And yeah, it was exhilarating and it's never stopped being exhilarating. It's, I think, a huge social movement. And the reason why the podcast is called The Flippening is because I think it's not about Ethereum to Bitcoin. It's about sort of replacing the US dollar as the world's reserve currency. And I hope it's BTC or I hope it's crypto. I hope crypto total market cap exceeds all fiat combined. And I think it will. It's just a matter of time. But what an amazing time we all live in. What a huge opportunity. everyone going around like, oh, Bitcoin's like 5,000 and then it's 10,000 or whatever. Is I can't own a whole Bitcoin. Dude, who cares? I'm not going to give investment advice here, but we are so in the early stages compared to where it's going to be.
Okay. So now, look, the thing with Bitcoin or crypto replacing USD, that's going to be huge. And honestly, personally, I also would like to see this. I think it makes total sense. The thing that sometimes disturbs me is how will this happen? And will this happen all of a sudden? Will this result in more destruction than actually creating something positive? What's your take on that? Because The US dollar is the blood of the financial economic system today. And changing it and bearing in mind when it became the blood after World War II or something of the kind, like the world was so much more not connected. Everything was so much smaller. So such a huge disruption when we're so much more advanced is really potentially could be terrifying.
Yeah, I completely agree. So first off, the first thing you said was, how long is it going to take? I think it's going to take a long time. So my parents recently bought their first thing on Amazon.com. Okay, Amazon.com was started 24 years ago. And even though a whole bunch of people are Prime members, the vast majority of commerce in the United States does not happen online. So it's a very long transition. Certainly the ramp up has been amazing. Amazon.com is one of the most consistently growing year-over-year companies that has ever been around. They're sinking their teeth into everything. But 24 years and most shopping doesn't happen online still. So I think it's going to take a long time, frankly. And what is it going to be like? I think it's going to be fairly non-revolutionary in the scheme of things because it's going to happen slowly. And someone asked me, hey, when do you think the Bitcoin ETF is going to get approved? I think the Bitcoin ETF is going to get approved when enough people at the SEC hold Bitcoin and are like, yeah, we want this to exist too, because they're holding it and they want it to go up. So I think when enough people at the SEC can front run the increase in BTC prices that result from the ETF, that's when we're going to have it. So I think a lot of people picture sort of like this crying and gnashing of teeth and social upheaval. And I think what's going to happen is little by little, people are going to buy some here or there. It's going to be speculative. It'll be on Coinbase. It'll be like they, got some from a friend or whatever. And then by the time it flips, no one's going to actually care because everyone's going to have enough of it, hopefully, that it's not this big thing. And when I think about who the losers are going to be, it's not going to be the rich people. So when I think about who is going to lose out, I think the rich people are going to be fine because they're always fine. And I think the poor people in places like Argentina and Zimbabwe and places that have had a lot of currency instability and understand the value of Bitcoin, they probably sold everything for Bitcoin a long time ago. When this happens, it's going to be the middle class and the poor people in countries that have historically had stable currencies. So it'll be poor people in Britain, United States, places with pretty developed economies that have always been able to trust this. And they didn't understand it because they haven't seen crazy inflation and they didn't have, sort of a spare cash to buy in early. And that's unfortunate.
Okay, great, Clay. This was a really, really fun conversation for me. Honestly, one of the best had so far. Awesome. And was truly educational as well. So I would like to end this off. So where can people find out about you and Flippening Podcast and Nomics, of course?
Yeah, so I'm on Twitter at Clay Collins. Nomics is just at nomics.com. It's just the suffix of economics. It's Nomics. The Flippening Podcast, just search for Flippening Podcasts, and wherever you get your podcasts, we're there. And we also have some forums at forums.nomics.com if you want to chat. Yeah, there's lots of ways to reach us. And for the most part, unless you reach out with some crazy vague business proposal or something, we respond to everyone who emails us that is truly just looking to engage because they like the content. We get a lot of weird people that are just writing for the first time. I love flippening. Hey, can you buy this thing from me? And no. But the vast majority of people that email us, we respond. And we're happy to engage and always appreciate folks co-creating awesome stuff with us.
Great. Okay, Clay. Thanks a lot again. And I'm sure we'll talk soon again.
Absolutely. Thank you.
A couple of things before you take off. First, if you enjoyed this episode, be generous and share it with your best friends. They deserve it, they will appreciate it, and they will be grateful to you. Second, I named this podcast Borderless Crypto because I have been fascinated by the speed with which crypto has been breaking financial borders. Just like the internet empowered us to communicate and share information with anyone, anywhere, 24/7, 365, crypto is empowering people of any country to transact freely, to invest in all sorts of assets, and to access capital to grow their economic status. I'm super pumped to be part of this financial transformation. That is why I'm doing this podcast, to spread awareness about crypto and to accelerate the removal of economic borders. If, like me, You want to see a borderless financial world? Help me spread the word about crypto even faster by spending 1 minute to rate this podcast, write a review, and subscribe, so that more people learn about crypto. And in this way, together with you, we accelerate crypto adoption. Finally, if you have any suggestions, feedback, or anything you want to tell me, send me a message on my Twitter handle at borderlessbtc. Thanks for tuning in, and I'll see you soon again.